shows, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, hello and welcome to the COB. I'm Nadine Blaney. It is the 1st of June and this is the COB. Wonderful to be here with you on this Monday afternoon. Look, it's a patchwork quilt out there when I take a look down at my heat map for this local market. So the banks are mixed. Some of the big miners are looking a bit mixed. We've got the insurers a bit mixed. You know what is really into positive territory is the infotech space. Of all things today, I guess you had to look to Wall Street and yet another record close there. But there's also been a bit of news in that part of the market that has helped drive things a bit higher today. And that is really what's helping to prop up this market in a more significant way than had perhaps been expected at the start of the session. I don't want to over-egg it. We've got the S&P ASX 200 up by 0.05%, but nice to see a bit of green on screen. SiteMinder is one of the best performers by percentage change. WiseTech Global is up by 9% as well. Over the past 5 days, the index has gained about 0.5%, but as we've heard time and time again, the ASX has really done nothing since the beginning of the year. And that kind of brings me to our three themes of the session. Mind the gap. We are 3 months into this Middle East conflict now, and Wall Street keeps printing records, but the ASX is flat on the year. Why? Well, in large part because the Strait remains shut. Week 14 and counting for the Strait of Hormuz. Until that resolves, does anything else really matter? And as I mentioned, tech has turned the best performing sector today. However, we're trailing the Mag 7 still big time. The Mag 7 is up 60-odd% year on year, so pretty much tripling expectations. And I'll be chatting with my guest about that one in just a moment. Let's look at these sectors though today just to see it in, well, red and green, mostly green on this screen here with WiseTech, as I mentioned, up by 9%. Life360 putting on 6%. NextTC up by 2%, and Tech One putting on close to 6.4%. Made me think of Rudy Philippek Van Dijk's view in our evening newsletter. If you don't subscribe, you should. ausbiz.co/newsletter. He's written a view on the tech space and his favorite stock, Technology One. Healthcare, it is a sector that has been battered and bruised in 2026. Taking a look at what's happening today, and we've got CSL down by 2.3%. Fisher & Paykel, ResMed also getting sold off significantly. In fact, ResMed is down by a further 7%. Not so for Pro Medicus. I mean, it's not really a healthcare company, more a tech company. It's renewed a 5-year contract worth $28 million, made another contract win as well. That was the stock of the day on the call today, and my guests saw it pretty differently. You might want to have a listen to that. Web travel has dropped after a managing director sold shares, down by 2%. Cettire, though, it's an online fashion, luxury fashion retailer, and its shares soared. It is expanding its presence in China through the launch of a flagship store, and it's on one of the big platforms as well. DroneShield, though, tanked over the weekend, said at home more than 25% of the votes were cast against its resolution to adopt the remuneration report. So that's the first strike in a 3-strike system. And Cettire Resources says that its offtake dispute with Tesla has been resolved and shares have reacted accordingly. All right, a very warm welcome to the COB, I think for the first time, Heath Moss from HLM Capital. Heath, nice to see you in the afternoon hours. How are you traveling today?
Nice. Yeah, very well, very well. Like you said, it's a bit of a mixed day, isn't it? Really didn't have much of a lead to go off from Wall Street, although they did hit record highs, like you said. But there wasn't any major macro news, or there was a bit of enthusiasm about the Iran and the Strait reopening and the deal being done. And then we come home and it really isn't that much news out there today. So I think the market reacted accordingly, and we're basically flat.
Yeah, I was sort of talking to the team here this morning and saying, we could be in for a little bit of a quieter period. We're not full on confession season before the August reporting season. It just feels a little bit like a watch and wait scenario. And part of that, would you put it down to the budget and the reaction to the budget as well?
Yeah, I think you're right. I think we're done with the Q1 US earnings season. The market's digested that and done very well. Obviously, we've got Iran still in the background, and like you said, there's no real corporate news from now until August here in Australia, apart from some of those confessions, in terms of earnings and trading conditions, etc., etc. So, yeah, it is going to go into a very quiet period, and I think the budget has dampened everyone's spirits a little bit. Those CGT changes and the changes around negative gearing, etc. I think caught everyone a little bit off guard. The month before they were announced before the budget, and then them trying to implement them into the budget, although it hasn't been legally done yet, sort of dampened everyone's spirits to go along with RBA rate rises and households starting to feel the pinch. So. Yeah, I think you got that right. I think everyone's just a little bit down at the moment on the ASX.
Yeah, we'll see. We spoke with Oxford Economics today. They actually think the RBA will pause now, but still, arguably some of the damage has been done. Okay, so US tech, it's the story that keeps on giving, right? And it's the AI thematic, and it's also the trickle-down impact of that AI thematic. Are you still 100%... in the camp that believes that this momentum can still continue to run, or are you starting to see signs of exhaustion from the exuberance?
Look, I'm probably more in the 100% camp that we've got a lot more to run. Not to say that there's not going to be corrections along the way, but I think there's a lot of runway left in this AI story, and we're only just beginning. And I think that Q1 earnings season really did show, maybe the market wasn't expecting what it got from Q1 earnings season. I mean, tech earnings were up around 54%. Overall earnings were up 17%. If you take away the Mag 7 and the 493, I think the earnings were up 16%. So I mean, it was a really surprising Q1 earnings season, and it caught a lot of everyone off guard. A lot of that had to do with the tech, but it also has a lot to do with the rest of the market as well being so strong. I'm not sure AI is trickling down just yet, although the margins are at records. So net profit margins are at records in the US. But for me, there's still a lot to go. The hyperscalers keep on telling us their earnings are restricted by as much compute as they can get out there. Everyone knows it takes a while to get a data center up and going. There's a lot of long lead items to get for data centers, etc. We've seen Anthropic had to throttle users because of so much demand, and now they've done a deal with Musk and XAI to increase that capacity. So I think there's a lot to happen. Then on top of that, I think the next wave is going to be, these companies that are buying these tokens off the hyperscalers, wait and see how the trickle-down effect works for them, and if it can translate to better earnings and wider margins for them. But then also edge computing. So edge computing has not been spoken much about. NVIDIA and Jensen, excuse me, were talking about in their earnings call, and that's all about onboard AI and onboard computing. So you're talking about autonomous cars, the robotics, etc. All that sort of has not hit earnings yet and won't for a little while, but that will ramp up over the next few years, and I think that's the next leg we're going to see.
Oh my goodness, it's a lot to get your head around, particularly then when you add in the overlay of these mega IPOs coming to market. So the likes of SpaceX, of OpenAI, and Anthropic. I mean, how and what is that going to do to, I guess, liquidity in other parts of the market? Because this is the size and scope of an IPO that we've never seen before, by far.
Yeah, it is. I think, what is it, an 80 billion IPO raising versus the next biggest was 30 billion. And then you've got, for SpaceX, and then you've got Anthropic and ChatGPT, OpenAI, behind it before the end of the year. So there's a bit of money that's got to be thrown into the market. But look, I mean, we've already seen what it's done to the space sector in the US. We've seen the space sector absolutely take off, for better use of words. and seeing the ASTS Space Mobiles, the Rocket Labs, and all that, run by 70, 80, 90, 100% over the last few weeks. So I think it's turbocharged that. I think the SpaceX IPO is initially going to do very, very well. I think it's structured to do very, very well. Only 4% of float out there. The indices, major indices, have accommodated so it can be included into those. So that means passive ETFs have to be a buyer basically almost on day one. Retail have not been able to get any of this stock whatsoever on the IPO or pre-IPO, so they're going to want as much as they can. And then the lockup rules. The lockup rules state that the first, possible sale of pre-IPO holdings can't happen until after their Q2 earnings, and the stock has to be up for 30% of 5 of the previous 10 trading days. So, I think that's going to turbocharge the market again. It's going to be interesting to see how the further lockup rules, cascade down for SpaceX, because they're different to usual, because usually it's just a plain old 180 days and then you can sell some of your shares. But the SpaceX have got different criteria along the way as to, who can sell what when. So it'll be interesting to see how that affects the stocks. But yeah, you're right. Some of this liquidity is going to come from somewhere. Some of it's going to be new money. Maybe some of it's going to come from Tesla, because there's a lot of expectations that Tesla and SpaceX will merge next year. I'm not sure where it's going to come from, but I think it's going to lead to a really hot market again later in the year. And it's great that we finally, as investors, going to get exposure to some of these great private companies that are going to change the world.
It's it's a story for the ages, no doubt. So Heath, here's a question. We're still very headline driven for what's coming out of the Middle East, particularly when it comes to oil. That is the poster child for, what has been a much longer war than had been originally, I guess, floated, for lack of a better word, by the US President Donald Trump. So what happens to energy markets if we do see the Strait of Hormuz opened, hopefully? Does energy just become, passé once again, or are there opportunities there, you think?
Look, I think initially we'll get a sell-off in the energy stocks. Your Woodside, Santos, etc. will come off. How much, I'm not so sure. But they've already come off a little bit as well from their highs. So if they were to come off, I think it is a good opportunity to buy, because it's my opinion that energy does not go back down to that $60 or $65 range again. It's going to take a long time for production to ramp back up again to where it was pre this war. And even then, there's talk that it can't get to that high again. There's too much infrastructure that's been damaged and can't come back online again. So I think that's a great opportunity to get into these energy stocks once we see that sell off, because analysts still have their expectations quite low in terms of the 1 and 2 year outlook for energy prices. So once energy prices are sustained, I think above $80 for a little while, we'll see analysts start lifting those valuations, and you'll get sort of a snowball effect in the share prices and a bit of catch up.
Okay, so we'll be watching energy. Now, what's the saying? One swallow doesn't make a summer, something along those lines. So, when you think about the beaten down tech sector in Oz, obviously we had a good day today, but do you think the selling is over? Are you still looking for bargains in that space?
Yeah, I'll just have a look at the sector before I came along with you, and notice that the US SaaS sector now is only down 12%, but we're still down about 32%. And I think that's because a lot of the SaaS guys over in the US, like your Salesforce and your Snowflakes and all that, have proven that they're a little bit more resilient to AI than we initially thought. And I think the Pro Medicus guy, Sam Hubert, said it today in his interview that, he thinks it's rather overdone. And I think it is for a lot of Australian SaaS stocks. Your Pro Medicus, your WiseTech, Technology One, ResMed, Xero, I think they're going to benefit more from AI than it's going to be a disruption to their services, because people forget that, someone could develop an app that maybe does the same thing that Xero does, but then you've got to, distribute that app and get it out to the world. So there's a lot of marketing and all that sort of gear that's going to go on. And there's much more to a company than just an app being developed. So a lot of these companies are still very high quality. Earnings are still growing at really rapid rates. And I'd back those names those in over the longer term.
Wow. Okay. Heath, it's been great to have you join us. We're out of time. But we'll look to have you back at some point. Really appreciate it.
Thank you. Good afternoon.
Thank you. And I can tell you that Heath Moss will be joining the call later this week. First time for everything. All right. And our stock of the day was Pro Medicus. And as I mentioned earlier, our guests did see this one differently. Andrew Coleman from Team Invest, as well as Kai Chen from MPC Markets.
You know, there's a lot of things going for Pro Medicus. I mean, they do have a very good moat, and you know, the reason why it fell was people were thinking that AI would be a challenger to the product, where you'd have competing products. But I think this is incorrect. It's actually an enhancer, and again, you know, talking about the moat that these businesses have, it's actually the contracts and also the proprietary data that they have behind. So in terms of Pro Medicus, you know, their contracts are extremely sticky. They go on for a long time. And it's recurring revenue. So they are actually doing really, really well in the US.
Well, it's down 70% since it was a year ago. So from that point of view, big falls do happen. I think Kai's hit on a really good point there. I mean, Pro Medicus is a wonderful company. It's one of the top handful of companies on the ASX. And we at Team Invest in our membership have been covering Pro Medicus and invested to some degree in Pro Medicus since as long ago as 2009. But I think the bit that the market gets wrong about Pro Medicus is always two things. The first is whenever there's the whiff of fear, markets overreact in the same way as when there's the whiff of greed, markets overreact in the other direction.
Let's take a look at the market leaders, and SiteMinder doing really well. That reminds me that we've got the new episode of the Investment Committee to come after this program. By the time you're listening to this in podcast form, it will be up online. And SiteMinder was a discussion point for the Investment Committee. So today, I think it might be a coincidence, but one of the best performers today. It does, though, after signing that Muse partnership, have a couple more bulls on side, bulls at RBC. Say that the partnership looks like a long-term tailwind. WiseTech Global up by 9%. It has been cutting staff, and while they may not be happy, its share price has lifted. Still talking about a moat for WiseTech. Pro Medicus with those contract wins. Xero, you just heard my guest Heath Moss talking about Xero, so perhaps a SaaS apocalypse, for Xero, a little bit overdone, and you can see Zip. So all those growth stories leading this market higher today, quite a difference. Let's take a look at some of those that did drag, though, on the market after all. DroneShield, after that strike against its remuneration report. ResMed down. It's really underperforming the broader market, isn't it? $26.59. Lend-Lease as well is off. Look, it's got capital recycling going on. It says that it expects more capital recycling deal by the end of June, but clearly not impressing the market today. Judo Bank also is lower. Last week it did a refinancing deal, which saw its share price do really well. Citi is a bull on Judo Capital still, and its price target was lifted 2.9% to $2.15 per share by Morgans today. Temple & Webster off by 4.7%. In the small cap space, I'll go quicker for this. ReadyTech, a deal, or I should say a takeover offer, has been reported in the AFR Street Talk, up by 18%. Cettire settling that deal with Tesla, and a couple of the gold names doing really well as well. Flipping the page to those that did underperform the market, Playside Studios, we saw a contract being cut by, I don't want to speak out of turn, but yeah, they've sort of lost one of their outlets, and that's sent the share price 32% lower. Peter Warren down by 27% as well. So what's happening tonight? Let's see. We get the final manufacturing PMIs from the US and the UK. We also get an unemployment rate for the EU tomorrow here. We get building approvals. We have GDP this week. We'll also be hearing from a couple of RBA speakers, including the Governor Michelle Bullock. We also get West Gold earnings tomorrow, so we'll keep an eye out on that one for you. Look, here is the close. That's the CBOE Australia Index. It shut right at 4. We're sort of waiting for the last trades to go through for the S&P ASX 200, and it has closed mildly negative, just flat, but off by 0.03%, 8,729. Look, we had a whole heap of wonderful conversations on the channel today. Excuse my French, but if you've missed any and you've got some time tonight, it would be wonderful if you could catch up with them. Please tell your friends about us. The more the merrier here at AusBiz, and we look forward to seeing you tomorrow.